What would an extra £1,000 sliding into your bank account every single year mean to you? A free city break? Emergency fund top-ups? Or simply proof that your money finally works harder than you do? Today, I'll show you how one well-planned basket of FTSE dividends can deliver that cash and why 2025 might be the perfect entry point. This video is for education and entertainment only. I'm not a financial advisor. Investing carries risk, and any gains or losses are your sole responsibility. Always do your own research and speak with a licensed professional before acting on anything you hear here. No recommendations to buy, sell, trade, or hold any asset ever. Why now? Britain's blue chip index is quietly yielding about 4% even after rallying to record highs this spring. Sprinkle in a few quality high payers and you're staring at 7 to 10% yields that crush cash ISA rates. With CPI back under 3% and the Bank of England hinting at rate cuts, real dividend income suddenly looks attractive again. The 4-step dividend blueprint. 1. Know your target capital. To net £1,000 a year, 5% yield, need £20,000 invested. 7% yield, need £14,300. 9% yield, need £11,100. Higher risk. The higher the yield, the more you must verify sustainability. 2. Pick sustainable high yielders. Ticker LGEN. Yield approximately 9.1%. What to watch? Cover 1.8 times. 5% progressive policy through 2024. Ticker BATS. Yield approximately 7.8%. What to watch? Cash flow from smokeless pivot. Payout less than 70%. Ticker AV to yield approximately 7.4%. To what to watch? 2024 dividend up 8%. £300 million buyback. Solvency II ratio 206%. Ticker PHNX. Yield approximately 10%. What to watch? Forecast insurance runoff specialist. Watch capital buffer. Ticker VOD. Yield approximately 7.7%. What to watch? 2025 asset sale proceeds fund dividend. Debt load remains heavy. Blend two stalwarts like Legal and General and Aviva. Add the cash gushing BAT, plus a moderate payer such as Diageo at 2.5% for ballast. Your weighted yield still kisses 7%, but portfolio risk falls sharply. 3. Use your ISA shield. Dividends above the £1,000 allowance are taxed at 8.75%, 33.75%, or 39.35% depending on your bracket. Shelter gains inside a stocks and shares ISA, and you dodge all that forever. Good news. The 2025/26 allowance remains £20,000, exactly the capital we penciled in earlier at a 5% yield. 4. Choose payout or drip. Need income now. Set dividends to cash and enjoy roughly £250 every quarter. Can you wait? Activate a dividend reinvestment plan. Reinvesting a 7% yield could double your shares and future income in just over a decade without adding fresh capital. Risks and reality check. Dividend cuts happen. Vodafone halved in 2019. Shell slashed in 2020. Diversify sectors and hunt cover ratios above 1.5 times. Share prices swing. Income investors still ride market risk. Focus on cash flow, not daily price noise. Tax rules evolve. Chancellors can shrink allowances overnight. Max your ISA early each tax year to future-proof earnings. Bottom line, £20,000 inside an ISA spread across 5 resilient dividend payers, including Aviva, can hand you £1,000 a year with room to grow. That's rent-beating passive income and a philosophical win. Your capital earns while you sleep. If this blueprint lit a fire under your wealth plan, smash like so YouTube shows it to more future dividend lovers. comment the FTSE high yielder topping your list, and subscribe for weekly money philosophy that turns hard numbers into real world freedom. Until next time, spend smart, think long term, and let your dividends do the heavy lifting.